All right. Thank you all so much for joining. We'll go ahead and get this thing started here. And first, I just want to thank everybody on this webinar for taking the time to join us today. I also want to thank Rich and Tang and Total Bank Solution for being a valued partner for nearly a decade. Rich and Tang and Infovisa have been working together since about 2015 and approximately $1.5 billion from 32 of our Infovisa customers administered by one of Rich and Tang's FDIC Insured deposit programs. And so through innovative approaches and time-tested methodologies, Rich and Tang has established itself as a beacon of stability and success in an ever-changing market. This webinar offers you a unique opportunity to tap into their wisdom, gaining a competitive edge, and enhancing your financial well-being. And as some of you may know, Infovisa and Rich and Tang have a streamlined integration in place today. And this interface streamlines the file transfer process between our two firms. So using this interface, sweep transaction and name files are exported to your server to upload to Rich and Tang using secure SFTP transmission. There's also additional balance and interest files that are downloaded from Rich and Tang to import into Maui as well. So if there's ever of interest of this, feel free to reach out to either myself or any member here at Infovisa, and we can start that process for you. So let's go ahead and get into the content. And today we're honored to hear from Mr. Kevin Bannerton. And Kevin is the Executive Vice President and Head of Wealth Management at Rich and Tang Deposit Solutions. And as the title states, Kevin leads Rich and Tang's Deposit Solutions Wealth Management Division with responsibility for the development and delivery of wealth management focused products, achieving firm targets for new sales and client retention, coordination of all marketing initiatives, and the prioritization of all projects related to wealth management. Also, in addition, Kevin is responsible for the firm-wide marketing and public relations efforts and oversees the securities-based lending business line. So without further ado, I want to welcome Mr. Kevin Bannerton. Kevin?
Thank you. Thanks, Josh. And then good afternoon to everybody. Thank you for attending today's webinar. Again, thanks to Infovisa for such a long partnership and the opportunity to present today. We hope you find the session educational, and at the end of it, the goal is to have you leave with a few ideas about how some of the solutions could be used within your own organization. What I'm going to do now is I'm going to come off screen because it's a little easier to see the presentation if I flip to that mode, and we'll go through the content. Okay, so hopefully everybody's seeing the presentation now. And for our agenda, we'll touch a little bit on our capabilities, a little overview. Josh did a nice job of that already, but there are a few updates from the last year that I'd like to highlight. And then moving on, we're going to talk about the banking crisis, spending some time on what happened, but because there is a lot of that information is readily available, we want to spend more time on why it happened, what's unique about that, and then what does that mean going forward for various stakeholders. We'll walk through a few real-life examples and use cases and touch on some of the products, because with everybody on this call, all firms are a little bit different, and how you use these capabilities can really represent that value in different ways. And that's what we'll spend the majority of our time on. Then we're going to touch a little bit on the current market outlook, spend a little bit more time on DDM, one of the key marquee products that we offer. And then lastly, how would you consider moving forward if this was something of interest? So as was discussed, R&T has been in business for quite some time, but one of our new updates is the fact that we've refreshed our brand. We're now going formally as R&T Deposit Solutions. And part of that was, you'd mentioned the combination with TBS about a year ago. We merged with Total Financial Solutions. So the combination of the two firms now is unified under one brand for R&T Deposit Solutions. And we continue to serve banks, wealth managers, including trust, fiduciary investment managers, relevant for this call for sure, and then also working with broker-dealers and other financial institutions. And what's notable, by bringing the two businesses together, we now have over $200 billion in assets under administration. We can now, by combining the two bank networks, offer up to $50 million of FDIC insurance. This represents over 350 participating banks and financial institutions in the network. And we're currently providing extended FDIC insurance for over 15 million individual customer accounts. And currently we're integrated with most core banking and trust accounting platforms. And just to summarize the key capabilities, I'll start on the left with our demand deposit marketplace. Again, this is a cash management solution tailored for banks, but also includes bank trust departments, independent trust companies. And what we provide here is access to this network of over 50 million of FDIC insurance. We offer similar capabilities for broker-dealers that operate under a different regulatory framework, and that's our RTID Insured Deposit Program. I mentioned earlier our loan management system, where we can connect and really provide a straight line through process of securities-based lending that starts from origination to the underwriting process, as well as collateral evaluation and monitoring. And lastly, when we think about our bank partners, we also think in terms of funding solutions and how our deposit programs can actually provide access to a diversified, stable pool of deposits across a wide network of counterparties. So in essence, these are our four main business lines. And was touched on earlier is we've had a long-standing relationship with Infovisa, which started in 2015, over 32 customers today utilizing our programs with about $1.5 billion in assets under administration. I touched on the DDM program, but it also includes the former TBS capabilities with our Insured Deposit Program. The main difference between these two programs is that the Insured Deposit Program, for those who may be utilizing it, generally have a lower insurance number, around 10 million. And this is more tailored toward independent trust companies with lower insurance need. The DDM program really focuses more on the bank and bank affiliated trust side, offering significantly higher levels of FDIC insurance. And as we move forward, we'll be looking to add more of the capabilities we discussed and working with Infovisa to understand your needs and where else we can come up with creative solutions. Now, touching on the banking crisis, it was, as you can imagine, it was we all know it was a very highly complex scenario that unfolded. So I think I'll use I tried my best to find the most complex way of depicting what happened. So this is what I came up with. The fact that we had a few key drivers, and this pendulum, I think in the end, the seesaw sums it up, where we had an environment where we had tremendously low interest rates for an extended period of time. And when that happens, what goes up? The increased liquidity in the system, added to that the COVID environment where there was excess liquidity pushed into the system, leading to higher deposit balances, which then led to fixed income prices that were much higher with lower yields. And for banks who were taking on these deposits and looking for places to earn a return, that's what increases securities investment, adding to duration risk. And then this lasting for an extended period of time started causing inflation pressure. So this is the backdrop of what we were dealing with. And then when things reversed, as things go up, they must come down. Interest rates started coming up. And now it was the removal of excess liquidity from the system, leading to lower deposit balances, lower fixed income prices, and the reversal of this investment. And this is where some of the banks started feeling caught off sides in terms of the rate and the speed of how this happened, and were they really prepared from a risk management perspective to deal with it. And now we're moving into decreasing inflationary pressures, but it's not at the same pace as rates have coming up. So we're in this transitional period, which is what's causing a lot of the stress in the system. And just as a reminder, because sometimes having lived through it, things happen fairly fast. And most of this activity happened in March, which I'll refer to as March Madness, but maybe a trip down memory lane where you can see from left to right everything from SVB losing $40 billion in such a short period of time, Silvergate, SVB, the FDIC, the regulatory bodies getting involved so quickly. So a lot happened within a very short period of time, and it all led to, what we take from this is the Federal Reserve and the FDIC issuing reports talking about some of the causes of the bank failures, and importantly, what might that mean as we go forward? And as we think about that, it's important to think about what happened now. And I think what was unique was when we look at it, we look at concentration risk. the fact that for the banks that experienced failures or were under stress, one of the common themes was that there was a very high concentration of large customers within the same industry, and they were highly correlated in their moves and impacted by a group of small influencers. So that was a unique dynamic from what we lived through. Compounding that was the access to information, the number of news outlets, social media, 24-hour news cycle, the impact of these influencers, plus the access to information made this a very unique time period. The third component was the ability to move quickly with reduced friction. So we always look at technology as advances. Sometimes it introduces different forms of risk, such as ease of withdrawal, real-time payments, speed of communications, which all led to what we describe as really a digital run. And that was what's different this time. There are newer risks to consider when we think about liquidity risk. And based on these events, what has changed? And I think because we were sitting in such a low rate environment for such an extended period of time, sometimes some of the core principles you can tend to lose sight of. For example, with rates being so low, there was no risk premium in the marketplace. Hard to differentiate uninsured versus insured deposits. So we now had individual investors or depositors really thinking about principal preservation again, what it means to access liquidity, what are the operational risks involved in cash as an investment, and really bringing back some of the concepts of diversification, for example. At the same time, depositors are evaluating or rethinking their risk assumptions. So are the regulators. They're thinking about the stability of deposits. What does it mean to be a stable deposit? Prior assumptions of classifications of deposits, such as core versus brokered, are being reevaluated. And I say that because some of the banks that experienced the biggest runs, those deposits that left were technically from core deposits, accounts that were opened directly. So the assumptions around core equaling stable were undermined during the most recent crisis. So there's going to be a reassessment about stability of deposits versus prior assumptions. And we also look at the asset liability risk weighting in terms of how the FDIC assesses insurance premiums, for example, and what that structure looks like going forward. And finally, I think what it really leads to is those assumptions about stability really started to come into light between the ratio of insured versus uninsured deposits. This is where the scenario really played out. It wasn't so much about that classification, for example, it was whether a customer felt they were exposed by having a higher level of uninsured deposits with the bank. And that's what really caused a lot of the activity this go around, and what influences the thoughts around stability of funding, sensitivity to liquidity risk, and particularly headline risk. So these are some of the key drivers that were the outgrowth or the extension of the crisis. And I think there was one quote that kind of summed things up in terms of the tone, was that the current market environment of declining deposits and runs on banks raises questions about whether the most deposit amounts are sustainable, especially uninsured deposits, reducing deposit franchise value. Tom Linsenberg, accounting professor at Wisconsin. So these are some of the market sentiments that we were experiencing. And as I move to the next section, I just hopefully was able to give you a bit of a backdrop, maybe a refresher on what we went through, but highlighting some of the key issues, because as we were working with customers through this environment, these were the themes that we kept hearing. And it always came back to, well, how can we work with clients to address these risks or these issues? And I'll share a few use cases. And the first was when we deal with trust companies and wealth managers, whenever you have a market disruption like that, there's always a concern about preservation of principal and access to liquidity. So these are the tenets, these are the primary objectives that come back into priority. So for most of the firms we're working with, the options are either to invest in money market funds in that scenario, if they're in deposits, uninsured, buy U.S. Treasuries, or open bank accounts with multiple banks below 250,000. So these are the types of immediate reactions we saw. And through our programs, the demand deposit marketplace and IDP for that matter, the ability to access upwards of $50 million of FDIC insurance through one account with rates that exceed Treasury and government money market funds, that was something that was viewed very favorably and was a good option in navigating through this recent crisis. The second use case that we saw come up was this issue around insured versus uninsured balances. For banks that started demonstrating or at least reporting higher levels of uninsured balances, there was a lot of focus among not only their bank customers, but also in the media about how this scenario can be managed. There are a lot of corporate customers, municipal customers that really have high balances and were sensitive to some of the potential risk. And when presented the scenario, there's a few options that are similar. For example, investing in money market funds or treasuries, but also the banks have the options of either setting aside collateral, whether it's in treasuries or surety bonds. The problem was that these became very expensive. Surety bonds went up in expense, and then also the amount of collateral that was required, instead of 105%, for example, for treasuries, it might be 120, 130%. If surety bonds were being priced at 15, 20 basis points, 50, 75, and if there were even options available because a lot of the capacity went away. The only other option in that scenario is to send the balances to third-party banks, but that is not beneficial to the bank because they lose those deposits. So what we saw through this environment was a significant increase in interest in our reciprocal capabilities. The fact that a bank can send a deposit out into our network, receive the same dollar amount back, and provide the excess FDIC insurance to the end customer was a real value. And that's where a lot of banks and the activity we saw immediately during this environment were for banks looking to solve that problem for their customers, to provide them a higher level of insurance, but not lose access to those deposits. So by sending it out to the network and getting the same dollar amount back, they were able to retain the deposits and control the pricing for that matter. So that became a very useful tool. And we also saw this with banks who had trusts and affiliated wealth managers working together to solve some of these challenges together. And I'll share one other use case is that we've seen a lot more activity in the banking as a service or fintech space, where third parties that are not banks who partner with banks who are offering deposit solutions, looking for high insurance amounts. And we have a unique scenario where if the client is not able to provide us with the full underlying customer information, we have what's called an Insured deposit equal allocation methodology, where we can allocate on a pro rata basis, providing lower levels of FDIC insurance, but operationally very streamlined. So there were some scenarios where clients wanted to get up and running quickly, didn't need a high level of insurance. So this was something we were able to solve for them, particularly in a stressful environment. So these are just a few examples, and I know for everybody on the line today, there's probably different applications. So what I'll do next is really talk. I'll touch on some of the details of the products, but hopefully this gives you an idea, and you may have faced some of these similar scenarios, and maybe there's an opportunity to introduce some of these capabilities within your organization. So where do we go from here? Just touching on the environment for a second. This is the backdrop, from an economic perspective. I want to touch on it from a macro all the way down to regulatory, just highlight a few key things, because this is from our perspective, the environment we're operating in, and what does that mean for us as we position not only our business, but our products going forward. But I think we all know that there's still a lot of economic uncertainty and fears of recession post the bank failures. Inflation has been showing signs of reversing, but it's somewhat stubborn in some categories while coming down in others. So I think we still have a trend where we have elevated inflation, or at least to a degree where the Fed is not overly comfortable with where we are. We're going to continue to see withdrawal of stimulus programs. Increased systemic risk to the banking system will likely influence the recent pause. So we know that the Federal Reserve paused at the recent meeting, but even the comments yesterday from Chairman Powell indicate that there's probably some higher rates coming, and they might even be in sequential meetings because there's still a need to rein in inflation. From an industry perspective, despite these bank failures, banks remain in good shape due to higher capital reserves, loan loss reserves, and ample funding. And I know yesterday the Federal Reserve produced the stress test results, which showed that the banking industry was very strong. But we are starting to see tightening in underwriting standards, signaling some constraint in access to credit. Competition for deposits has and will continue to increase, and this is having an impact in terms of the cost of those funds for banks. Another reason why some of the reciprocal capabilities have been attractive. It gives banks a little bit more control around the cost of deposits. And we do think that moving forward, managing this ratio of uninsured to insured deposits will play out. And that's an important point for investors or depositors, because the rates that banks are willing to pay impacts the products and the competitiveness relative to money funds. So if we were talking a year ago, we would have been talking about banks flush with deposits, not paying much for deposit rates, and actually money market funds in that unique environment were probably looking very competitive. That whole situation has reversed now, where the trends from last year have seen money funds, flatten in terms of their rates, because the yield curve is now flat to inverted. Deposits are priced much more aggressively. Spreads are much wider, insured deposit programs. So that all has basically turned into a reversal of the trends that we saw in 22 as we moved into 23. So what that's leading to is insured deposit programs are outperforming money funds back toward more historical norms. And what we also see is that any potential changes for FDIC insurance, when we talked about those initial assessments, they looked at everything from insure everything, insure nothing, no changes, or limited. It seems like if anything was happening to be very narrow, it could be toward operating accounts in terms of any changes of FDIC insurance. But even then, it would require congressional approval, and that could take years. So we don't see anything happening immediately there. On the other regulatory front, there have been some proposed changes to money funds. These have not gone into effect, and it's been relatively quiet, but the proposals, the way they were presented, would actually increase standards for liquidity within the money funds, forcing them to become a little bit shorter, increasing their overnight and weekly positions. So over time, that would end up having probably a negative effect in terms of the rates in those portfolios, because they'd be more subject to repo and overnight investments. And depending on the final rules, there could be some additional complexity with something they refer to as swing pricing, a way of absorbing risk as if there was a stress event. But there's more details to come there. But this is the environment we're operating in right now. So I touched on the DDM program earlier, but just to remind everyone again, it is an automated daily cash sweep program, enables banks, trust officers to offer up to $50 million of FDIC insurance. And for banks that participate, again, they can participate either as a send institution, a receive institution, or reciprocal. And what that means is a bank can just purely place deposits into the program to get higher returns on the excess cash. Or they can be a receive only, where they just use it as a funding tool. And for many banks, they participate both ways, where they can act as that reciprocal bank, where they can send and receive and dynamically change that preference depending on their funding needs. And really, those program advantages, it gives the bank more diversification and funding sources, flexibility on the balance sheet management, and a way to manage costs. But what's really become important for investors is the safety. As I mentioned, with principal preservation becoming, so much more important, having that $50 million of FDIC insurance is really critical per tax ID and ownership category, and really no exposure to any NAV volatility. Same day liquidity without any liquidity gates or redemption fees, and diversification across the banks versus all through a single fund. And I think the other thing is important is to make sure that there's the flexibility for anybody who might be using the program or is thinking about it. The question also often comes up, are there ways that I can opt out of certain banks if I have an existing relationship? The program is built to handle that. It's a technology-driven program, so we can handle opt-outs as you need. And again, performance-wise, it's been very competitive relative to money funds. And just drilling a little bit further into the reciprocal side, the flexibility is really important because they can manage that ratio of insured and uninsured. And what it does, it'll also allow is for banks, under a rule that was passed a couple of years ago, the banks can treat reciprocal deposits as non-brokered up to the lesser of 20% of liabilities or $5 billion. So it gives banks a lot of flexibility and headroom to take advantage of these types of deposits. And for anybody who's on the investment side, because these are non-brokered, banks in some circumstances may actually pay a higher rate because they find them to be attractive, which helps the overall program rate. And just to briefly walk through how it works, and I'm going to simplify things given the time frame we have today, but essentially customers with cash balances in investor accounts are sent daily into the program, and we are providing record-keeping, administrative, custodial services, and Huntington National Bank is the settlement bank for the program. So it's operationally works the same way cash balances are sent into money market funds today. With the DDM program, the investor deposits are allocated across the network of banks to ensure that each of the deposits are less than $250,000 at each bank, and making sure each customer's balance are fully insured up to the marketed number, which I mentioned is $50 million earlier. And that's how we're simply able to access that higher level of insurance. And all the activity is coordinated within Infovisa, fully integrated into the platform, and really streamline the back end on your behalf. From a performance standpoint, the product over time, as I mentioned, some of the trends have been reversing from last year. So on a one-year basis, the institutional DDM rate has outperformed an index of funds. What we have been tracking, and some of you may be receiving this competitive analysis, is that we track the 8 largest commonly used money funds in the trust space and compare our institutional rate against that over all time periods. And the current rate today, just for anybody curious, it's a 503 on a net basis, but this gradual spread historically has been over 10 basis points, 10 to 15. It seems to be moving in that direction. Got a little bit compressed during the COVID era because of the low spreads, but that seems to be reversing now, showing higher net rates. And we will send this presentation out because there are some unique attributes of the Insured Deposit Program. If you look at it feature by feature when compared to money market funds, that you may find helpful is really talking about it. Most cash investors have a few key priorities, whether it's safety, liquidity, earning a competitive rate of return, and then thinking about the structure and the operating risk. So it's probably good to have a good idea what the main differences are between, say, an insured deposit program or a money market fund across each of these dimensions. So when we think about safety, we're really talking about that FDIC insurance. And because there's no securities in the portfolio, there's no NAV price risk. So that's a difference between the structure versus a money fund offering 100% daily maturities. Also, from a liquidity standpoint, funds provide liquidity at the fund level. So it's really at that individual fund level that the liquidity is available. And within the bank programs, each participant has access to their insurance at the individual customer level, basically at the individual bank level. So even if there was something to happen with one bank, the rest of the portfolio, the rest of the allocation would be fully liquid. So that direct access, as opposed to going through a fund structure, is a difference from a liquidity standpoint. We've talked about the performance side, and then one is simply a deposit account versus a fund structure. So this may be something you'd want to spend more time on, but I want to at least highlight this, and we will share this presentation for those that are interested. So with that, I hope you found the information we shared to be useful. And what we'll do is we'll open it up to some questions now.
Thanks, Kevin. This is Teresa with R&T. Hi, everyone. I'll just go through a couple that came over. Can you hear me okay, Kevin?
I can hear you, yes. And I'm going to go back
great.
on video.
Yeah, no problem. So I'll just go through a few that came through on my end. It's Question number one was, how would you describe the current medium to long-term economic market for money funds versus FDIC products? I think you went over that a bit. I don't know if you want to elaborate.
Sure, I touched on it, but maybe I'll go into a little bit more detail. So as I was referring to in the presentation was the fact that last year you had such a unique environment where, because there was so much liquidity in the system, banks did not have a need for deposits. So the pricing of those deposits was down, where historically you would generally find banks willing to pay something like Fed funds plus 15, plus 20 in a normal market environment. That was Fed funds flat. It was zero. So the spreads on deposit programs were low relative to historical norms. At the same time, the market was pricing in increases in interest rates. So the short end of the yield curve steepened. Money funds, for example, have the ability to invest a little bit further out, take duration risk. They're able to capitalize on that one phenomenon at the same time while deposit rates were lower. Now, as the market is anticipating the end of the rate cycle, so even though there may be one or two additional hikes, we're at closer to the end than the beginning. So the yield curve is flat to inverted as you go out. So that duration benefit is principally gone away. And deposit rates, the spreads have widened dramatically. So that unique scenario that took place last year has reversed. So going forward, we anticipate that insured deposit programs will consistently outperform given the environment we're in right now. I hope that helps.
Great, thanks. I think we have time for a few more. Another one that came through was, how is R&T managing bank risk across individual depository institutions?
Sure. So one of the criteria for participating in the program, and this is a regulatory requirement, is that for banks to receive deposits, they have to be well capitalized. So that's kind of a starting point. But what we do is we do look at banks across a few different dimensions, because we're interested in any emerging headline risk and also any risk that could cause a bank to go less than well capitalized. We do have a program that we run internally. We have some proprietary software that runs what we call a shadow camels, which basically replicates the same methodology a bank regulator would take to do an on-site examination, and using that as a basis to see if there's any emerging risk. And then we do have a credit risk department that looks at all the call reports, looks at the main ratios, and then we'll actually engage with banks directly to have a better understanding. Part of it is just for us to better understand what's happening within the bank environment and any individual bank. If there are any demonstrated risks, to understand why. Now, we always want to be a partner with banks, so having an understanding of what's going on always helps. But those are the things we do to try to make sure that we're thinking about risk and making sure that the banks in the program satisfy, not only the regulatory, but also, continue to meet and don't represent an issue going forward.
Okay, thanks. Another one that came through, are there any limits on the size of deposits that you can accept right now?
Right now, there's really no limit on that, but I'll put a caveat on it, because if you're thinking about sending deposits into the network, the way we work is we work with banks and negotiate contracts for a capacity level and a rate. And right now, because banks are so interested in receiving deposits, we have probably upwards of 10 billion of excess capacity right now for banks who would be willing to take deposits. So sending dollars in, not an issue. The thing we always have to track, however, and the caveat I mentioned, is for things like reciprocal, there's a matching of not only banks in capacity, but the number of tax IDs, and then also the level of insurance, because there is some dependency on the number of accounts and how much insurance they need. So for a single bank counterparty looking to reciprocate, we're probably looking around 1.5 to 2.5 billion per bank, depending on the mix of their customers. The lower the insurance need, the more we can do, and vice versa. So there are some things we would need to consider, but right now capacity is very much available.
Okay, good. We have time still for a few more. One was, how
Okay.
quickly can I start using an FDIC product?
Generally, from start to finish, if you're just looking at it today, it's probably between 60 and 90 days all in. It can be shorter. We've done things faster. For those that are already integrated, for example, with Infovisa, that could be as 30 days. So we like to guide people because there's usually a legal component, making sure the terms and conditions, everything in place for that and notification. So ideal scenario is probably somewhere in that 60-day time frame, which is reasonable. Sometimes a little bit more, sometimes a little bit less. But it can be faster if most of the integrations are already set up and it's just a matter of turning things on.
Okay, a couple more integration type questions came over too. So one thing that came over was, does a bank need to already utilize Infovisa products for its banking operating system in order to utilize this product?
It's not a dependency, but it's something that certainly we'd encourage. If you're using Infovisa today, the best way to take advantage of the products is to work through the Infovisa platform, of which we're already integrated. So I'm not exactly sure where the question is coming from, or whether it's someone who's considering joining Infovisa. But essentially, in the trust world, if there's a trust platform, trust accounting platform, operationally it works much better if we integrate with the trust accounting platform that you're working with. I hope that answers the question.
Okay. And then this one was regarding choosing the banks we invest in. By choosing our own bank products, does that create a conflict on the limits?
I'm sorry, could you repeat that question? I missed that.
This one came over, hopefully I'm reading it right. Regarding choosing the banks that we invest in, by choosing our own bank products, doesn't that create a conflict of interest? Or I guess, does it?
I think what that may mean is that if it's, for example, money coming from an affiliated trust to a bank, I'm going to use that as the assumption here.
Yeah.
Does it create a conflict of interest? So what we've seen is that banks who have an affiliated trust department can take advantage of that pool of money as a funding source, and what it really comes down to is the terms and conditions and disclosures. So there's not necessarily a conflict of interest. It really comes down to how, because if the trust side is really looking at it from a fiduciary standpoint, is the rate that I'm receiving and the benefit that I'm receiving consistent with the goals of the investment policy, and are they satisfying their fiduciary duty? So that's the view from the trust side. And if the bank is participating in a way that still satisfies that, and we've seen examples of that happening, they can work together. So that's generally a conversation between the trust and the bank can participate either narrowly or more fully. So sometimes it's a bank just taking part of the deposits, or sometimes it's really integrating with the reciprocal solution and working with the trust on that side. So there are ways of doing it. There are ways of addressing it. But hopefully the framework I just described answers the question.
Okay, thanks. And I might have read that wrong, but do you have time for one more?
Sure, I think I can do one more.
Okay, that's fine. I think this is probably one that, the question came over, how often can the opt-out list be updated?
That could be handled as much as daily. Not everybody operates that way, but from our perspective, it's just how you choose to send us the information and the frequency. So ideally, it's something that comes in a file. It can be manual. We really support lots of different methodologies. The main goal is to make sure that if an investor or depositor wanted to make sure that they opted out of a bank, to make sure that their dollars are fully invested and fully insured, we want to accommodate that in any method and as frequently as needed. So daily is the short answer, and we can do it lots of different ways.
Okay, great. Thank you. I think I covered most of the questions.
Okay. Well, I'll just say thank you then to everybody for participating. Thank you for Infovisa to help coordinate this and for the continued partnership. And if hopefully some of this information was beneficial, if you think there's ways that we could be helpful to you, feel free to reach out to either someone from Infovisa or the R&T team, and we'd be happy to have a direct conversation to see how we might be able to solve some of your challenges. So thank you once again.
Thank you, Kevin.